Hello, everyone. Hello, my name is Santiago Muguruza. I'm part of Spark's leadership team, and I also lead BBVA's investments in private capital, and which is an activity that BBVA has done for many, many years, mostly focused on fintech. But in the recent past, we've been quite active investing in VCs that operate in our markets, in the markets where Spark has operations. But also, we've been active investing in funds that focus on energy transition and climate tech. That brings me to today's topic, which is of crucial importance, which is the huge funding gap that many climate tech startups face when they're transitioning from an early growth stage to industrial scale. And in particular, what we would like to cover today is to help early stage founders prepare themselves better and prepare the companies better to attract the very necessary capital from later stage funds. And for that, we have two rockstar panelists that have a breadth of experience in funding and investing in climate tech startups. Please, Jamie and Bastien, come join me on the stage. Thank you very much.
Thanks.
So, before I start, a brief introduction about Jamie and Bastien. Jamie Gilbert is a principal at TPG Rise Climate Fund. Prior to that, he worked at Macquarie and British International Investments, focusing on renewable investment and infrastructure investment in the energy sector. And he's also served the board of many companies. In fact, he's flying in from a board meeting in Berlin from yesterday, and thank you for joining us today. And Bastien Gambini, he's a managing partner at Klima, which is a growth stage climate fund managed by Alantra. He's also has a lot of experience in VC and PE in the climate sector, specifically in energy-related sectors, more than 20 years, and he's also served the board companies of more than 13 companies. So thank you very much for joining us. I think that the best way to kick it in is to start by understanding better the type of funds that you work for and your investment strategy and what your thesis is, and then we can take it from there. So I think we'll start with you, Bastien. I'm managing this. Here we go.
Thanks a lot for having us, first of all. Good morning, everybody. So just 30-second commercial seconds on Klima, right? So the fund is indeed dedicated to energy transition. We invest sort of, I guess, late stage venture growth stage. So in terms of series, it might be series B, C, D, right? Whatever you call it. We invest in sort of successful startups in the sense that they would already be in commercial revenues, like let's say 3 to 5 million, north of that, in terms of commercial revenues, already customers, etc. Technology proven, out there in the field working at the customer side. We don't shy away from hardware, so we do software and hardware, right? From our point of view, it's needed in the energy transition to do both. In terms of size of the funds and then ticket size, so it's 210 million euro funds. We invest Europe and North America, and then ticket size is like 10 million usually upfront. We can double down, so basically putting 20 million in the company, which means in Europe at least we go to rounds from 15 to 50 million euros. Historically, that's what we've structured so far. And then usually we bring our friends together in the syndicate, right? We're pretty hands-on. We're quite on top of the company on the long run, right? So for good and for bad, I guess that's the.
Thank you.
That's the truth.
Awesome.
Yeah.
How do I do this? Thank you, Santiago. Pleasure to be here, and thanks to BBVA Spark for hosting us. The bank's a great partner to TPG. It's a great partner to our Spanish portfolio companies, so it's always great to be in Spain. But just telling the story again, I promise in 30 seconds, on the Rise platform, which is one of the large-scale impact investing platforms globally, focused on private markets, which which was born really in 2016, 2017 on the west coast of the US, designed to do kind of growth equity rounds, backing kind of cool businesses in fintech and healthcare and education, but has really grown from there, with the leadership of Jim Coulter, who was the co-founder of TPG, and Hank Paulson, who was the Treasury Secretary in the US that led the US through the financial crisis, really stepping into climate very aggressively, recognizing that it's one of the generational challenge from a global standpoint, and also as an investing opportunity ecosystem. And so the way we have attacked the kind of climate problem is at the large end of the spectrum. We raised a $7.25 billion private equity fund in 2021. That fund is largely invested. We have 24, soon to be 25 portfolio companies in there. We're doing a huge amount in the climate space across a number of spectrums. And in the future, we're going to be out in the market with our second private equity fund. We have a movement into infrastructure, recognizing that a huge amount of the climate investing opportunity is going to be building things. It's going to be physical assets, and we have to match the capital to what's needed. And then finally, spending more time and investing in the Global South, in partnership with the Abu Dhabi government. We've set up a fund to address better Sub-Saharan Africa, South Asia, Southeast Asia, where a lot of the problems and issues we're dealing with in the developed world are kind of coming down the track, and so it's important to be active there as well. So we're doing a lot of climate investing. We're probably a little later stage than where some of you guys are at the moment, but keen to chat about some of the key things we look for and some of the issues that we see.
Thank you, Jamie and Bastien. So the whole idea of the panel was for the audience to get a better understanding on what you guys look for when trying to invest into companies. So I would very much like for you to give us a brief overview of your thesis and the type of companies that fit within those thesis, and within that, what kind of metrics or what kind of inflection points you're looking for when investing. You want to go ahead?
Sure. Yeah, happy to. It's a great question. I think the most important thing that we look for in businesses at any stage is unit economics. We kind of found most of our thinking about what businesses are and what they can become on the unit economics that they have demonstrated and the unit economics that they can get to, and how many sort of miracles or how many things you need to believe to get from A to B is kind of foundational. So I think expanding on what that means, if your company is doing whatever it does, what are the four-wall unit economics of doing that? How much revenue, how much gross profit do you make from doing that? And as an investor, do I just need to believe you do that 10 times as much, and then that will make the business a viable business, a profitable business, or do you need to believe that the unit economics will fundamentally change, that you will make more gross profit from doing the same thing, and why do you need to do that? And what will be the triggers for that? And do we believe that? And can we diligence that? Are all important questions. So I think unit economics are like really the foundation of every company we look at. I think alongside that there are some more like really obvious things like quality of the management team and the depth of the management team. If a business presents us with a plan that says we want to become huge in Spain or huge in Europe or huge in the world, and they only have 10 people or 20 people, it's like a real red flag. So just going deeper on capability to scale is another one. And then finally, I think market potential is something that we always try and have a perspective on before we meet a company, i.e. whatever space you're playing in, we want to bring our own perspective on where the market's going before we hear a company's story on it.
And also from at least from their pitch, or the ones I analyzed, because we are this, one of the themes that you comment a lot in your investment strategy is that you're very data-driven in your investment approach. Can you help us make that more tangible? What does it mean in practice?
Yeah. No, I think data-driven comes from our roots. We're at its core, TPG is a private equity investor. that ventured into growth investing, and from growth ventured into impact investing. And so we love things that are measurable, and we love looking at numbers. And this is kind of what I was saying about unit economics. You know, we try and break down what a company's doing into the drivers of revenue and gross profit. And we try and look historically at what's happened and why will that be different in the future. And so when we talk about being data-driven, really we talk about trying to break down the numbers and understanding the core drivers and what you need to believe in the future to make a business, you know, as the previous panel talked about, worth three times its money or 5 times its money, whatever the right metric is, depending on your stage of maturity.
Thanks. Bastien, do you want? I wanted to ask you something specific, but before that, if you want to complement what Jamie said on what you look for when you look for investment opportunities.
Yeah, I guess at any stage of maturity of the company, people would look for the management quality, scale, right? I mean, the capacity to grow, because, I mean, you do 3x if you're growing, right? Otherwise, it doesn't work. And some kind of uniqueness or differentiation, right? So those 3 things are pretty true all along the value chain. What is a little bit different where we sit or is that we start looking at gross profit, unit economics. Can you actually make money on what you're selling, right? So it's, okay, you might have a cost roadmap, it's great, but if you can have a proof point that you're already making money somewhere in your business out of a product, then we feel way more comfortable to take the risk on you making money on other stuff later down the road, right? So gross profit is a key word, and yeah, unit economics. Can you actually make money on what you're selling to your customers on your side of the table? Right? So that is probably a little bit the differentiation on the criteria side of things, right? The later you go, actually, the more proof point you need to have that you can actually make money out of that at the P&L level, right?
And considering that you've been in the market looking for opportunities for the last 20 years, more or less, what are you seeing in terms of trends, of themes that are emerging, that you are interested on, and others that perhaps were in vogue 1 or 2 years ago and are no longer?
So we focus more on the energy side of the whole climate tech spectrum, so I can speak about energy only. And not everything even. But I would say that there is not one technology that can solve everything, right? So it's like, you cannot say nuclear is going to solve for everything. You cannot say hydrogen is going to solve for everything, or batteries are going to solve for everything, right? So it will be a mix. It is a mix, and it will be a mix. The mix will evolve, so there is not like a killer app that can solve all the issues in the energy transition. So there will be cycles, nuclear is coming back, hydrogen is sort of fading out, but probably will come back at some point when it's more economical, viable, the green hydrogen part. I think now there's something that was not true like 5 years ago, which is more true today, is that battery use cases are more and more viable from an economical point of view than 5 years ago because of the price of the battery dropping, right? Be like solar panels, wind turbines, etc. to a less extent, but definitely batteries are way cheaper than it was 5 years ago. So there's a number of use cases that, okay, you're avoiding CO2 by switching to diesel to batteries, but it actually make economic sense for you as an end customer of the battery, right? So now we're getting to the point where we can start storing electrons at the right price, right? I think that's interesting because it unlocks a lot of use cases behind that. With unit economics, that works.
Interesting your comment about green hydrogen fading out and maybe coming back again later. And so that must be quite a challenge for both of you, managing funds that have a very predefined investment period and usually in the 10-year range, perhaps a little bit longer. So how do you think about the investment horizon versus maturity of the investment you're doing, and you know, it must be very tricky, particularly if we are looking at industrial plays, no, that have, you know, very long construction phase and markets have been developed.
Yeah. Should I take it?
Sure.
Yeah. No, it's we none of us can control the maturation of the markets that we're seeking to sell into, and so I think what's important. And this is on us as an investor community, is we set expectations amongst our investors that these markets will not just go in a straight line, right? There's going to be years where, or periods of time where green hydrogen is less in vogue, or, data centers are the new cool thing. And so we have to set expectations with our investors that patience is going to be required in climate more so than in, traditional investing segments, and why we think climate investing is a sort of domain or a specialism on its own is kind of for that reason. We do need more patience. We can have companies that are well positioned to take advantage of these trends, but it is fundamentally unpredictable, and sometimes we overestimate how far through the climate investing cycle, this kind of mega trend that will outlast all of our careers, we are. So I think our investors certainly get it. It's not a 3-year thing. It's going to be 5 years, 7 years, 10 years, longer before companies mature. And they also get that what we think today or what we thought 2 years ago isn't necessarily the same today. So I think it's all about, we set our investors' expectations correctly. You set you as founders set our expectations correctly. You guys can't guarantee when a market's going to come. So as long as everyone's eyes open.
Well, you mentioned also nuclear fusion, so that's a good example of something that's been multi-decades under development.
Still 20 years away.
It's still 20 years away.
It's been 20
every
years
year, 20 years away. So changing gears, Bastien, because we promised that in this talk we're going to help founders better prepare themselves for the next funding rounds. So in your experience, what are the biggest challenges that companies and founders face when transitioning from that VC stage, early growth, to industrial scale, later stage type of phase?
I guess there's different kinds of challenges, but the most recurring ones we find is sort of the first challenge is you're a successful startup. Now you need to become a successful SME, right? Sort of regular SME, regular not being a bad word. So you need to set yourself for that next step. And that means, first of all, probably reinforcing the team at C-level, at senior management, right? So this is something we do every time we invest in a company. There is probably the need for an upgrade at the CFO level. Probably they don't have a head of sales that know about really strategy, how to sell through different channels, etc. And it's fine because, the phases before you didn't necessarily need that. But now you need that. So it's reinforcing the whole platform, the organization, right, for that next step of growth. The other thing is also looking at your investor base, your board, and then potentially also make some changes there, right? And set the board and your stakeholders for the next step, right? You might have some investors that want to exit because they are at the end of the lifetime of their funds, and they're at the board, and then you get that new guy coming in that wants to say 5 years because he wants his 3x, so there's no way he's going to do 3x in 2 years. And so there is conflicting views within your board, which is not good, right? So you cannot solve for everything, or that's the way it is, but you need to at least face those challenges like, okay, I have an investor that wants to exit now, he's not able to exit, he's still at the board, and it's going to push towards a quick exit, whereas these other guys want to have the long-term view on the strategy of the business, and you need to reconcile those two things. So those are also challenges that you might face, right? That the partners you picked for the first part of the journey are not necessarily the partners you need for the next step, right? At all levels. So it's like, yes, think about partners on the long run. Who do you want to have in your board, in your management team, etc.?
Which goes to the point from the prior panel, as well, about long-term thinking and having investors with deep pockets that can help you, in the first subsequent rounds.
Yeah, I guess deep pockets, and then people that can help you also in hard times, because over the next 5 years, they're going to be that shitty year, everything's going to go wrong, and then, okay, who do you want to be with, right? Who's the guy or the girl you feel comfortable with to go through that year that is going to happen for sure anyway.
Jamie, anything you want to add on that topic?
Yeah, no, totally agree with all the points that Bastien made. Like, I think they're they're all incredibly important. I guess what I would add would be one of the challenges in this sector is and it doesn't again speaks to this sort of why climate may become an investing speciality rather than a general topic, is the kind of non-linear capital needs of startups. Like, a lot of businesses have to build things, or whether it's a factory or a plant, or just make a lot of investment in human capital in a less linear way than traditional startups do. So thinking long term about how you're setting yourself up, and I think it's the other side of the same coin. How you set your capital base up for the scaling you need the next round and the round after is super important. And I would just I reinforce the point around, like, pick an investor who you think's gonna be your partner when things go wrong, because they do almost always. And the person who's willing to underwrite the highest valuation is often not the same person who's going to be your biggest supporter when you have a bad quarter or a bad year. They're often not the same people, which is an advert for people who pay lower valuations but are better supporters. And
to your point on the non-linear nature of the funding cycle especially in climate tech, when companies are building FOACs, etc. In your experience, is deal structuring something relevant when you enter a company, and how you plan the subsequent rounds? And what happens to prior investors? Because there are many times fears that early stage investors sometimes get wiped out when the big investors come in. So if you can comment on that a little bit.
Yeah, no, I think it's really important problem with the climate space in startups that consume capital as they grow. We haven't found a way to happily have investors who are investing like large sums of money, and it's often with ongoing sort of capital allocation decisions after they've invested, to happily coexist together in a board or in an investment committee. It's within a company. It's a really hard and kind of unanswered question, and we've seen it on a few businesses in peer investors' portfolios rather than our own, where someone new comes in and they want to be calling the shots, and it's their money that's being used to grow, and so they want to be in charge, and there's a tension with the founder, and there's also a tension with the earlier stage investors. And I don't think we saw that maybe in like software more generally, or even in climate businesses that just do software. We don't see that same tension, but where you're building things, where you have physical assets, it's a sort of unsolved problem. And so finding the climate sort of the investor ecosystem, finding a way to be solutions capital rather than, here's my investing style and playbook and you just have to take it. Finding a way to coexist with existing investors, with founders, to give everyone what they want is really important. But I don't think there's an answer to that just yet.
No, that's good enough. Thank you.
More problems.
So I think we're out of time. Any final words of recommendation for founders you want to share with the audience?
I think really for me it's like, choose the persons you're going to be comfortable to work with on the long run. That's really, at every stage, is really the key. And then back to your point on valuation, etc., the highest bidder, that's of course important. You don't want to be wiped out of the cap table as a founder. You want to still have some sort of economic value moving forward down the road. But you create way more value with the right partner, growing up the top line, growing up the gross margin, etc., than optimizing for the last mile the price of a given round in your Series B or C or D, right? So really, when you're sort of going through new rounds, also step back a little bit from the negotiation of the term sheet and the terms and then the valuation and the lick pref, etc., and step back and ask yourself the question, do I see myself working with those guys? Really, that's important. And the other thing is like, do your due diligence also. We do an awful lot of due diligence on you guys, but you guys should do due diligence on us, right? Pick up the phone, call the CEOs of the portfolio company or the ex-portfolio company, etc., and see how they operate, how whomever you're discussing with is operating in after the closing. Because the real story starts after the closing, right? Before it's just technicality somehow. So I think yeah, who do you want to work with, and then do your due diligence on those guys, on us, basically.
Yeah, I agree with all that. I think it's good advice. I think get to know your future investors early, have an idea in your mind, and be intentional about the way your capital structure is going to evolve. Think 2 rounds ahead. Don't think about this round in isolation. So, yeah, and that point on reverse due diligence, if an investor doesn't want you to meet their existing founders or CEOs of their current portfolio, that's a real red flag. But
well, we're running out of time. Thank you very much. This has been
awesome.
very interesting. If anyone in the audience or throughout the day wants to contact our panelists, please reach out to me or any of your Spark client contacts. I will be happy to connect you. Thank you very much. Up next, we have a very exciting panel about how is life after an exit, conducted by Ainhoa. And thank you very much.